today we have the opportunity to go through advantages and disadvantages of incorporation in a little bit more detail. Because of course, it might sound attractive that you can run your business through a corporate structure, and there are various advantages that one can easily come across, like some tax advantages, some organizational advantages, defining your responsibilities and obligations with other people who might be involved in that business. All that stuff is good. But there are some costs involved, and there's a great deal of bureaucracy. So you need to have a way to balance the costs and the bureaucracy and the paperwork and potential consequences with the benefits that you might have had running a business through that function. Of course, all this assumes, ladies and gentlemen, that you have a business. And if you don't have a business, maybe there's no point. Sometimes people get confused by this. You might be thinking that if I start this off as a corporate form that makes me look official, then this is the beginning of my business. Not really, because if you don't know what you're doing, you don't know what you're making or who you're trying to sell it to, you have no leads for potential clients and no idea how to generate a revenue or kind of have some income in any event, then you're not going to get very far. So the fact that you've registered the company doesn't mean that in and of itself makes a business. So the business plan and the idea as to what you're doing in terms of goods and services and customers needs to be there already. The business form is what helps operationalize this in the most efficient manner, so then you get the maximum benefit out of what you're trying to do. So if anybody here is thinking, well, I would like to become an entrepreneur or a business person, I will start off by setting myself up as a company, maybe this isn't a great idea. It could be that what you actually want to do, for what you actually want to do, the company form is not the most appropriate form for you. Have we talked about our friend Salomon? Salomon, back in the day, and we're talking sort of Victorian era level of business, was running a shop. And he was running this quite successfully. So no problems there. Parliament passed legislation which enabled the creation of corporate forms. Salomon thought, oh, this looks interesting. They're doing this, they must have a reason behind it, it probably looks like a good idea. Discussed it with a few people and thought, okay, how about we take advantage of this and use this newly created corporate form as the vehicle through which to run our business. At the time, the law didn't allow somebody on their own to set up a company like we have today, but you needed to get a bunch of people together. It was supposed to be a sort of collaborative exercise to bring together groups of people who were engaged in business. Obviously, Salomon didn't have a group of people because this was his own personal business. His family was involved in it. So he actually got his family members and kids to sign on as co-creators of this company. No problem there. The law required that you have a number of people. Since he had a number of people involved that wanted to do it and sign on the paperwork, this was perfectly fine. So he tries to go through the steps of incorporating the business as a company. Gets the number of people required, goes through the paperwork, gets the permissions that the law said that you need to obtain before you start trading. At that point, he thought, all right, now I've set this thing up. And the whole point behind this new legislation was that the company created is actually a different creature in the eyes of the law than the people who make it. That's why we come back to notions like separate corporate personality and so on very frequently when we discuss about business organization. By going through the paperwork and getting the permissions and getting the certificates and so on, this new legal person has been created. Distinct from Salomon, distinct from all the people who were working with him. But that new person in law doesn't have any money. So would Salomon simply gift the business that he was running to the company? That might not be a great idea because this was his livelihood. If he just gifted it to the company, then it would belong to the company and he would be left with nothing of value for himself. So this wasn't an appropriate way to do this. But the company is usually set up, and at the time it was set up with some minimum financial contribution, but this wasn't significant enough to purchase the business. So for the business to transfer from Salomon to this new entity, the money needed to come from somewhere. So Salomon made a loan to the company. And the company then used the money from that loan to purchase the business. Now, this sounds a bit strange. So Salomon is the boss already. He sets up this company that is in law distinct, but in fact, there aren't any different people involved, it's still him. He takes money out of one pocket, calling it a loan, sticks it into the other pocket, because that's the loan that's supposed to come back from that's the purchase money in the transaction. And not only money goes from one pocket to the next, like the loan comes out and then it comes as purchase money back in, Salomon still has entitlements, because as the creator of the company, he is the shareholder, so he owns now this business, and this business has acquired a valuable asset. It is a bit of a difficult thing to digest, but the end reality in terms of the law is that the business no longer belongs to Salomon, it belongs to the company. And Salomon is now a shareholder, he's got a stake in that company, but he's no longer the business owner. The company did not totally repay the loan immediately, so he used the money from Salomon to purchase the business, but not all the money came back immediately. For whatever was left, Salomon had some security features in the paperwork to make sure that he recoups the rest of his investment when it comes to it. I'm not talking about the shareholding part of the investment, because when you participate as a shareholder, you make an initial contribution, you buy a piece of the company, and that's it. If the company goes bust, then you lost that piece. But if you make a loan to the company, you can include terms and conditions in that loan that gives you some element of protection. If you get a mortgage from the bank will secure itself by having a claim over the house, so if you don't actually repay the mortgage, they're going to come and take the house away. So the bank is not investing in you and your family life, the bank is giving you a loan, and to elevate their chances of having that loan repaid, they've got a stake over the property. It's perfectly normal stuff. If you get a consumer loan, again, it works in the same way. If you borrow money on your credit card, it works in the same way. It could be that the bank then has a stake on the thing that you purchase, and so on. This is all very normal. So Salomon gives a loan to the company. The company uses that money to purchase the business. The business goes away from Salomon and it becomes the company's. Salomon still has money to receive. This money is protected in the paperwork because the paperwork sort of elevated him in the first place. If something goes wrong, he would be the first person to be paid amongst a variety of other creditors that might be there. This doesn't guarantee that you get your money back, but it means that if you're first in line, you've got higher chances of getting some money back than if you were last. Equally, when the bank has a claim over your house, if you don't pay the mortgage, when they try to sell the house, if the prices have dropped, the bank might not recover the full value of the loan. But that's a risk that everybody takes when making these types of transactions. Externally, life continues as if nothing has happened. Because the people who were doing business with Salomon, his employees, his customers, his suppliers, probably noticed nothing different. The shop's in the same location. They do business with the same people. They meet the same people when they go there. The nature of the business, the type of goods, the payments, nothing really has changed in any way. Perhaps some detail in the paperwork is different, but the reality of doing business has not changed. Up until the point where something went wrong. And it did go wrong, not intentionally, but the business started performing poorly, and at some point, it couldn't repay the loans. It couldn't pay invoices and bills, it couldn't satisfy the customers, it couldn't satisfy suppliers and so on. It happens when a business runs into trouble. When people came to ask for their money back, they came to Salomon. And they said, we haven't been paid, now you owe us money, so it's time to cough up. Salomon went, well, it's not me as a person that you're dealing with anymore, it is the company, because we had set up the company and so on. If the company is not able to pay you, then it's a problem between you and the company, not a problem with me. Salomon could be a shareholder, it's not a problem for him. He could be a company director, yes, he's still the person representing the company, but again, it's not his own money that's going to pay the company's debts. But the people who were losing their money didn't see this the same way, and they were not particularly pleased. So far as they were concerned, they were still doing business with the same person, and they felt they were getting scammed. So they went to court, and they said, look, this isn't right. It's the same person here. The business has always been the same. We were dealing with this gentleman. Suddenly he tells us it's not him and it's some kind of phantom virtual entity that doesn't have enough money to repay us. Not only this, he got his money back. So whatever this phantom entity owed him, he was the first one in line. He got repaid. We didn't. So, what is this? So their argument that the court was that this is some sort of a scam, and surely the intention of the legislator could not have been this, to create a legal fiction that then allows people to get away with running their business poorly. The court had a look at this and they said, well, actually, weird as it may seem, this is what the law said, so the consequence is this. Why is this important for us? Because this was nailing down the notion that a company is a distinct entity and its money is distinct from the money of the shareholders, the money of the directors, or whoever is involved in it. So the court had the opportunity to challenge this legislation, this new form of business that came in, and to interpret this legislation. And what they came up with was that, yep, this might look odd, but this in fact was the intention of the legislator. So if you have a problem with it, talk to your MP. So it's a matter of changing the law. But it's not a matter of Salomon having done something wrong. He didn't do anything wrong. Now, of course, you need to remember that he didn't sink the business intention. If this was a scheme to defraud the creditors by shifting the company when he knew that the company was in trouble, then the outcome would have been completely different. But there was no evidence that Salomon was complicit in any problem, that he was running the business poorly or anything like this. It was his bad luck. And it is logical that the people who were at the losing end, they would try to test this in court to see what happens. But also it is logical that the court found in favor of Salomon because he did what the legislation allowed him to do. The value of the company is determined by the assets that it's got at its disposal. If the company seemingly has got some stuff that are valuable, maybe it's got some stock, maybe it owns the building, maybe they've got some vehicles or whatever it is. These days they might have IT equipment or whatever. But if you try and sell all this and generate an amount of money, if the money that you owe is way in excess, then you cannot satisfy everybody. So inevitably some people are going to lose out. Now the method by which you determine who gets what in what proportion and how do you put people in an order to figure out who gets paid first and who gets paid second, this is something that we deal with later on, because there's a developed system to allow you to do this. It's not like at random somebody decides who gets the money. But when a business goes bust, it goes bust because the money it owes is in excess of the assets that it's got at its disposal. It is as simple as that. Separate corporate personality is now nailed down. We know that this exists. We know that the company is a separate creature in the law. It's as if another person has been born, but it hasn't been born by somebody giving birth to somebody. It's been born by a legal act. And we also know that limited liability, that could be one of the added functions of a corporation, is in fact real and it is respected. Not everybody, not all countries in the world have the same understanding of limited liability, but it is a very popular concept. So the majority of private limited companies around the world will operate with the same logic. So it has become an essential component of capitalist market organization. It is very difficult to run effectively a market economy without corporations that benefit from separate personality and limited liability. It could be done, right? And it's been done in the past, because civilization existed before the Victorian era where all these things came on, but it would make the economy look very, very different. Now let's take a step back and think about what goes in the inside bits of a corporation. Every company has a constitutional document in the same way that every state has a constitutional document. Why you have a parliament, what the parliament does, why you have a government and what they do, what the judiciary does, how these elements link with each other in order to govern the place, right? Everybody has this. Now, in this country, because we're so chill, we thought it's funny not to have these things written down. In other countries where people have a more healthy appreciation of their relationship with the government and they don't trust them, they've got it written down in a document. Now, what everybody does and how they do it. Corporations usually involve more than one person. It is never a good idea to do any sort of business without having things expressed in writing. You will remember that it's not a requirement in English law that contracts are in writing. It's possible to have a contract that is oral, fine. Possible it may be, but it's not a good idea. Because once you start arguing about who's doing what, then A, you have difficulty proving it if it's not in writing, but even if you can prove it because you're recording everything, for instance, where everything was by WhatsApp messages, it might lead to ambiguity and confusion and trouble and dispute. So having things expressed in writing is a great idea. In order to create a company, this is not a nice thing to have, it's an obligatory thing. You need to have things in writing. Therefore, every company has what we call a constitution, which contains a series of documents. One of it is very mundane, is the Memorandum of Association, which is just a kind of pro forma thing that says, hey, we're happy to set up a company. It doesn't really say anything of value. I mean, not these days. Historically, it used to tell you a little bit about what the company is supposed to do. But now the memorandum is a simple statement that says, yes, we assent to set up a company as the initial subscribers, which means the initial set of shareholders. What the company is supposed to be about, you can include in that, but also the government asks you to pick a designation, is like a keyword, a specific code that says if you're engaged in this type of business, use this code, number 1 means this, number 2 means that, number 3 means that. You can pick one just to give people an impression of what your business is about, but it's not the end of the world. I picked the wrong one. So when I was going through the list for my company, I thought, I'm doing educational consultancy. It's not really featured anywhere. I picked one for consultancy. Wrong one. The one I picked was for kind of geothermal surveys and kind of digging up the ground and taking samples at times. Do I do any of this? No, I don't. Is it a problem? No, it's not, because nobody really cares. It's got no legal consequences, just for classification of the company's house information. So the memorandum that used to ask, what is it that you do? It doesn't really matter. You can put whatever you want. The other one is more important. The other document are the Articles of Association. So if you try to think it in relation to what is the government's constitution, so how is a state run, if you had a written constitution, in our context for companies, these are the Articles of Association. These say very clearly who does what and how they do it. So it's going to tell you what are the shareholders supposed to do? How are they supposed to make decisions? How often do they meet? How do these meetings take place? The board of directors, who are the executive body of the corporation, there's information in there that says, how do you become a director? How do you stop being a director? What is a director supposed to do? How does the board come together? How do they make decisions? What happens if there are disagreements between them? How do they communicate with the shareholders? What authority do they have in relation to the outside world? Lots and lots and lots and lots of information, which is obligatory to have and then work. Now you must be thinking here, hang on a second. If I'm starting in business, I've got a business plan, I've got perhaps a product, I've got an idea for some clients, maybe I've been doing it on my own for a little bit as a sole trader and now I want to scale up by setting a business. I'm focused on the substance of my business. I don't really know anything about that stuff. So what am I supposed to do? Am I supposed to just kind of sit down and think, okay, Articles of Association, Article 1. I don't know, somebody makes decisions. Article 2. I don't know, we ask each other how to make those decisions. It's not a document that one can just write. I'm guessing you could ask ChatGPT, give me a sample set of Articles of Association for a corporation in this country, and it would do a fantastic job. But you don't have to actually do this because the legislation provides you with a pro forma. We have what we call model Articles of Association. For the type of corporation that you're after, you have model articles for a private limited company, for a public company, for a variety of different forms that you got between those. So you can actually pick this coming a statutory instrument that is attached to the legislation. You can pick the appropriate thing and just copy paste it, and it's fine. If you're doing this online, when you're setting up your company, you will auto-fill in the information of your company at the top and in places where it needs to be, and that's it. You just said, I adopt the model. You're done. So you satisfy the requirements of the legislation by having your constitution written down, but you didn't have to come up with all the details for yourself. Well, you know. Now, if you're thinking, how am I sure that this is appropriate for me? This stuff is super generic. So there isn't, unless you are trying to do something out of the ordinary, and you would know if you're trying to do something out of the ordinary, there is absolutely no problem picking the model Articles of Association. When I set up my company, I just click, dang, done. I didn't even click the thing to open it because I knew what it said. So there's absolutely nothing to personalize unless you already have a purpose that you know needs to be expressly written there. Yeah? So you don't need to change the model that they give you. It's perfect. Now, if there was something about your company that you know makes it distinct and needs to be written down, then you can go and amend. You want to impose limits on the decision-making power of the director. It could be that you're a small company, but there are quite a few people involved. Let's say 5 or 6 of you are setting up something. 4 of you are going to be shareholders, but only 3 of you are going to be in the board of directors. Now, as a group, the 6 of you, you're a little worried that the directors might go off the rails and start doing stuff by themselves. So you can put in the Articles of Association something that says, any purchase decision with a supplier or any contract negotiation that goes above a certain value requires approval or requires shareholder meeting approval or something like this. This is not by default in the model articles because most companies do not need this. I don't need this because I'm the sole shareholder and the sole decision maker. So I'm the director, I'm also the shareholder, I'm everything by myself. I'm not going to argue with myself, am I? Maybe I am. But I should be able to resolve it with myself without having a process in the Articles of Association to force me to do it. But if you know already that there is something like this you want to take care of, you can have it expressed right there and then by amending the model Articles of Association. And that you're allowed to. If you are trying to get information about an existing company, you can extract their Articles of Association because these are public documents. So the constitutional documents of the company are public-facing documents. If we are doing this in the context of study, and I tell you, this company, you're dealing with this company, was established in 1984 or whatever, just be mindful that if I tell you that it was built on the model Articles of Association, you need to pick the model as it existed at the time that the corporation was set up. Because the model changes, they upgrade it every few years. So what is the modern one right now might not necessarily be the same as the one that they had in 1984. So you might need to look at the historical version of the model Articles of Association to see exactly how that company was built. If you don't have if it's not a real company and you don't have the exact information. If it's a real company, you can go look it up and get the actual Articles of Association. In terms of the legal environment that informs how businesses are run and how they operate, there is, of course, the law outside, but the most important documents are the documents that the company has produced for itself. So the constitutional documents of the company, primarily the articles of association, are the most important source of information about a company. So you should always start there. Now, what happens if they amended the articles and they put something in there that is not allowed by law? Well, this is not applicable. It's not going to work. It doesn't negate their entire articles of association. It just means that if you come across something in the articles that the law actually prohibits, then nobody can rely on that provision to achieve a particular outcome. Do people argue about the articles of association? Normally not at the beginning, because setting them up is usually not a controversial process. What happens is when they attempt to change, and we're going to see later on what is the process for changing the articles of association if you want to change something or include a new provision later on. Since the company is a legal fiction, it cannot operate by itself. Now, of course, these days, you can get something that is not human to communicate with you just fine, because you could feed your articles of association, the company's objectives, all the company's literature into ChatGPT, and then you can role play with ChatGPT. So you can feed all that information in there and then tell the AI that you are the company director and I will be a supplier, let's negotiate a contract and see what happens. So in that sense, now, even though it's a legal fiction, it can talk to you and it can negotiate with you. But from a legal point of view, it may be a separate person in the eyes of the law, but it's not a real person that can actually interact with the world outside. In order to interact with the world outside, it needs to do this through a human agent. Maybe they're going to change the law in the future to say that it's no longer a legal fiction in the sense that it requires a person. It can actually run itself. So the company is technically a legal fiction, and still is, but it requires a human agent. Who is the human agent that does stuff on behalf of the company? It will be the company's directors. The directors can operate as a unit, as a board, because when all the directors are there, it's called the board of directors. This is the decision-making body of the company. But the directors can also act independently. If you're dealing with a company, how do you know who is responsible for making decisions? If somebody comes with the title of director, you know they're the boss and you can talk to them and you can get stuff done. Anybody who has the title director is technically authorized to represent the company and enter into the deals on their behalf. People who are they're not directors, but they're part of the management structure in a bigger corporation, they will usually represent themselves to the public as having the opportunity to contract on behalf of the company. If you're trying to do a business with Amazon, I don't think you're going to talk to Jeff Bezos. But you don't have to talk to the big boss. You don't have to talk to the CEO. You talk to somebody within the management chain that has authority to conduct deals on the thing that you're trying to talk about. And they will be upfront about this. But do not assume that anybody who works for a corporation is authorized to speak on behalf of the corporation. Can I enter into contracts on behalf of the university? I might be able to if the circumstances allow for it. The head of school during a meeting tells me, here's the company credit card. We ran out of juice. Run down to Tesco and get us some juice. If I go and purchase at Tesco some juice and I pay for it with a university card, we might be able to assume that, of course, I wasn't buying for myself, but this is a retail setting. Since I use the card of the university, an assumption has been created that I'm an authorized representative for this transaction. So if I came back to the school carrying raspberry juice, bring it back, and then we got into an argument with Tesco as to whether I was authorized to carry out the transaction already and who is responsible for paying for it. It might get a little bit tricky, but I don't think it will be a real issue. I cannot, however, ring up HP and say, I would like new laptops for everybody. Why would I know I work here, and you can Google me and you find that I work at the place. But why would a random employee have the authority to carry out significant purchases, things that should be part of a procurement process in a bigger corporation? If something like this happens and they go for it, it should have been obvious that I'm not an authorized representative, therefore it's their fault. So the contract created will be a contract, but it will be a contract personally with me that I put in the order, not the university. So if HP invoices the university for £100,000 for new IT equipment, the university is going to say, we don't know what you're talking about, and we're not going to pay that. And they will be able to come after me, who's the person that concluded the contract, but I won't be able to pass it on to the university because I did something random. If somebody who's in the board of trustees of the university, that would be the equivalent of a board of directors, calls HP and says, our vice chancellor has too much to drink, and then rings up the Apple store and says, new iPhones for all the kids. Then the university would be bound because as he's the boss of the whole place, there's an assumption that he's authorized to do this. If he made a mistake, and if he violated some restriction that is within the internal documents, within the constitution of the company, then that becomes an internal issue. So people internally can go after him for what he did that was wrong, but they cannot negate the contract with the Apple shop. So I hope you understand the difference, that there is a difference between people who are understood to be authorized representatives because they have an official title, or people who are within a management chain that creates an expectation to the outside world that they're allowed to do this, and kind of random people who are somehow associated. But the company needs the authorized representatives to be able to interact with the outside world, because otherwise it may be a real person in the eyes of the law, but it's got zero capacity to interact with its environment. And you will notice that if you see any document signed with a corporation, or you see a contract done with a corporation, it will say signed on behalf of the corporation. So when I sign a contract with a customer of mine for my company, I will not sign as Yanis, I will sign as Yanis representing the company. So they know for sure, and it's nailed down in the documentation, that I'm not, in this instance, I'm not acting in my personal capacity, but I'm acting on behalf of the corporate entity. Now, this stuff is normally not very difficult, but it does generate disputes when somebody has done something wrong. And it generates a great deal of internal disputes when people within the company have figured out that the bosses have actually made some mistake or violated some restriction that was in place because, people were worried about this. But you will need to be able to distinguish between mistakes that are internal problems and are resolved within the confines of the company, and mistakes that actually have external consequences, and you can ring up the supplier and say, this wasn't us, so don't send us the laptops or whatever it is. Agency is the mechanism in the law that allows you to represent somebody else. Perhaps it's worth just to say that you can be an agent of somebody because you're directly authorized and you market yourself as such. You say, I'm here, like you go see an estate agent. This is a direct, overt relationship of agency. The agent will take you and show you a house on behalf of the landlord. That's the whole point. Or you're an actor and you have an agent to represent you and get you into deals. Again, they will be upfront about that relationship. Sometimes you have such an overt expression of the agency. Sometimes it's implied by circumstances, as for instance, you being a company director. You don't have to tell people you're there to represent the company. The fact that you went as a company director is enough to convey that message. Sometimes you got agencies that are not disclosed, which gets a little bit trickier, because then you think you're dealing with one person, but in fact you're dealing with somebody behind them. Most of the time when you're dealing with corporate entities, it's not a problem because you know that you are trying to deal with a corporate and not with an individual. When you go into the Apple shop and you try to buy an iPhone, you're not buying the iPhone from Mohammed who works there. Okay? You're buying the iPhone from the Apple shop. If you wanted to buy from Mohammed himself, then you would buy on eBay. So if it's a private seller on eBay, then you're buying from that person. If you're buying from a sales representative in a shop, you're not buying from the person, you're buying from the shop. The important information about corporate capacity is that any restrictions in the ability of the company to carry out actions do not have consequences on external parties unless the external parties have been told explicitly. If I go and negotiate a deal with somebody and I say, in order for us to sign this needs to go through the board of governors, get approved, and as soon as I get that approval, then we will be able to proceed, the third party is aware of what's going on. Therefore, if I call them the next day, let's say, yes, I want the deal done, and they ask me, did you get the approval? And I tell them, whatever, it's going to come anyway, don't worry about it. Then they're in the know that a process has not been followed. So then this does not result in a valid contract if, in fact, there's been some internal violation. But they are under no obligation to ask. And that's important because in previous versions of the law, because the company's constitutional documents are public-facing, there was the assumption that the public had constructive notice. It means that you are assumed to know something because it is in the public domain and you have the opportunity to figure it out. So the old versions of the law put the burden on people dealing with companies to look them up and figure out for themselves whether they're allowed to do stuff or not. This isn't a great idea because first of all, nobody actually does this. And secondly, it puts an inappropriate burden on people when they're trying to conduct business. So the modern version of the law does not put any burden on a third party. And the third party only participates in whatever trouble he's got if they're actively complicit or they've been told about it. Sometimes they're complicit because it's a little bit of a scam going on. But otherwise, any third party that deals with a company is dealing in good faith, and any contract that is concluded by an authorized representative will not be invalidated by any internal irregularities. So even if the Articles of Association say the board is not allowed to purchase anything that costs above £50,000 without obtaining the approval of the shareholders in writing, and one of the directors goes and buys a van for the company, which is in clear violation of this, the contract with the car dealer is still valid. It is a clear violation of internal rules, but it has got no consequence on the car dealership. It is an internal problem, and then the company can go after the director for not having respected the rules in ways that we're going to see in the future. The reason for this is Section 40 of the Companies Act, where it says that third parties do not have to care about internal violations.